for many years, we have internally here at JWB, we have made decisions based on IRRs, but whenever we have talked with all of you out there, we have talked in terms of ROI, return on investment, whereas IRR means internal rate of return. And so internally, we know that higher level, longer business decisions or investment decisions really are made by an IRR. So why don't we talk about that in terms of selling our properties or in terms of how you're making decisions? Well, the reality is that IRR is pretty complex. It's harder to understand. It's more complicated. And so my nervousness for really bringing this topic up is like, how can I connect with you on an individual level and help you understand why this is so important and also not complicated? How can this still be easy? And so that's really where I would love all of your help out there. If this isn't connecting, if this is a little bit too complex or just doesn't really relate to how you can make a decision on a rental property or on another asset class, then let me know, because this is really foundational. I think as a not your average investor, this is one of the kind of standards that if you can really understand and you can really rally, which one are we going to there, Pops?
I'm trying to follow your eyes.
If you can really understand and really rally around understanding IRRs at a deep level, you're going to make such better decisions. You're going to know how your investment decision on buying a rental property compares to your decision on investing in a share of stock or buying a business or doing whatever it is, syndication. You're going to have one set scorecard to make, not your average decisions. And so I'm excited to bring this concept to you. This isn't just like a drop in and like talk about this today. I want this to be a living, breathing thing, because in the rental property investing world, in the turnkey rental property investing world, nobody talks IRRs. Nobody talks about it, but they should. And so people don't always know why they're making a certain decision in a certain market or with a certain provider. And so my hope here is not only do you understand more about how your money is working for you or the decision that you're making in hopes of your money working for you, you are better informed, but this is not just about rental properties. This is helping you inform between other asset classes. And there isn't a more important time right now to understand a little bit beyond just your sphere, a little bit beyond just rental properties than right now, when the rest of the investing world, the stock market, right, crypto, stocks, bonds, mutual funds, your traditional stuff, syndications, a lot of stuff is changing. And what I am hearing and what I know is that we are desperate for a way to compare apples to apples.
So let's start in the beginning, man. What is the main difference between ROI and IRR?
Well, so let's start with what we generally talk about and probably have some feeling of familiarity with. It's your return on investment, right? Your return on investment. We have talked about it for years now on the show, right? You take your net returns, which is like the amount that it's worth today versus what it was when you invested in it, right? Your net return over your initial return on investment. That's your return on investment. And so, if you have an asset that was, $100,000, a property that was worth $100,000, and let's just keep it simple and say it's worth $200,000 now, right? And so you earned $100,000, but you bought it in cash. So your investment was $100,000. You have $100,000 for your net return, and you have $100,000 for your investment. So it's 100% return on investment. That's 100% return on your money. But nowhere in there does it talk about how much time it took you to earn that return on investment. If I told you that your property value went up in 1 year from $100,000 to $200,000, we're all super stoked. We're excited about that.
Yeah,
What
definitely.
If I told you it took 30 years?
A little less stoked.
You're a little less stoked.
Yeah.
Well, return on investment doesn't have any way to compare time. And so when you're on an investment in an asset class like rental properties, team, right? Not your average investors. Do we talk about buying and holding in the short run, or do we talk about buying and holding in the long run?
The long run, obviously.
Right.
Yeah.
The long run. Buying and holding for a full market cycle is how you win 10 to 20 years. So return on investment largely is done to look at a 1 year return. Okay. It's usually good for a 1 year return. That's kind of what's implied, or at least the best way to use it to make decisions. Where it fails is if you go out longer than 1 year. Your financial advisor or somebody else who's peddling an investment to you may say, geez, listen, I can deliver an 80% return on investment, 100% return on investment. They may be 100% right on that. But if it took 10 years or 20 years to get there, well, then that starts to, of course, make that return on investment not seem so appealing. In real estate, especially in turnkey rental properties, we never really had to differentiate between return on investment and IRR back in the day, because there were so many overwhelming wins when you just talked about every profit center, not named home price appreciation, that it just flat out beat an investment in the stock market, right? Whether that was a 7% or 9% return or 10% return, 2 years ago, a year ago, right? It beat the stock market. You didn't even have to talk about home price appreciation. Well, what we're seeing now is that the game has changed. We've been talking about this for years as far as why cash flow was never the end-all be-all reason to invest in rental properties, and how I've been saying, listen, people are going to have to learn how to evaluate these other four profit centers. Well, guess what? That time is now, because cash flows have gone down. They have gone down. If you're only talking about return on investment, you're talking about the things that hit your bank account this year, that's largely cash flows, right? So cash flows have gone down, but that doesn't mean that this asset class still isn't the best return on investment, the best risk-adjusted return on investment for many of you. We just need a scorecard to evaluate all of that. When you start to throw in home price appreciation into the mix, which we need to show now because cash flows have diminished, we need to show this too, because every other asset class, stocks, bonds, mutual funds, syndications, they all show home price appreciation or stock price appreciation in their return. So we have to do that now. Well, the tool to be able to justify that appropriately is not ROI. Many other turnkey providers still use ROI, but it inflates your return on investment. Your money will never work that hard. So we have to, together as a community here, we have to get to an understanding of IRR, because that's how this asset class actually works. We put money in today, we buy and hold for a 10 to 20 year period of time. That a lot more money comes to us back in, down the line in 10 years or 20 years. We need a way to equate for how hard is my money working each and every year until I get to that finish line.
So why don't you just kind of break down a little bit of so ROI is numerator, denominator, money out over money. What does the IRR calculation look like so we can start conceptualizing?
So let's talk about what IRR has that and equates for that ROI doesn't. I talked about timing, right? So how long does it take to actually receive the cash flows, and then the variability of the cash flows. And it's all based on this concept here, where if you have money today, that is worth much more than that same amount of money 1 year from now. Pablo, why is that the case? Why would you rather, let's say you have $100,000 today. Why is $100,000 today different than $100,000 1 year from now?
Because $100,000 today, I could put into a private lending program, and that could turn into $110,000 a year from now.
Right. Yeah. You have the ability to reinvest. When you have money in your bank account, you can reinvest that money, earn a rate of return on it. And so what IRR allows us to do is it takes into account the reinvestment of those funds. It takes into account how long it took to get those funds back to us, neither of which return on investment can account for. Okay. So it's about timing and variability of cash flows. That's what IRR allows us to do. But what we're doing here is we're saying, all right, so to calculate IRR, I've got the money I put in, and I'm getting varying amounts of money over the next 10 or 20 years, and I'm getting a big lump sum at the end. How do I equate and give myself a rate of return that my initial money would have had to earn each and every year to earn the equivalent of all of those variable cash flows? It is a really complex way to look at it. But at the end of the day, it's like, how hard's my money working?
Yep.
It's really easy to see how hard your money is working when it's on a 1 year schedule, which is largely what return on investment is. But this is the way to see how hard is my money working? How do I compare this to another asset class, this return on investment, my IRR return on investment, that is my standards, like across the board scorecard. So if you want me to go a little bit more in depth
Go
into it.
technical. Give me the
All
thing
right.
that you dropped on me this morning on our run that you were really scared of.
So let's just go with a completely technical definition
Yeah.
here, which may not resonate with all of you, but we'll scale it back from there.
Let
right?
us know in the chat.
The internal rate of return is the discount rate equal to making the future values of the net, equal to the net present value of the future values of cash flows equal to 0. The discount rate, so that the net present value equals makes the future values of the cash flows equal to 0.
Got it. So discount rate is another word for saying the actual return, right? Like the percentage of what you are returning is the way that I understood discount rate, right? So if the discount rate equals the actual return percentage, and now we're making the future versus net versus present equal to 0, the difference is that now you're not just saying what money you're going to get back over what money you put in. You are saying the whole lump of money that you are going to get at a specific date and time, be it 10 years, 20 years, or whatever, you are reverse engineering from that moment back to this present moment. And then the discount rate is what you got from that, so that as you age that money, when you compare it, it's equal, right? It's 0.
Yeah, you're getting to a place where you're like, you could pay me this amount of money today, or you could give me a lot more money in the future. And you're like, nah, I'll take either one.
Got it.
That's what we're saying. The net present value of the future cash flow is equal to 0. That's just saying, like, you could give me this amount of money today. I'm assuming I'm going to earn a certain return on investment, and I'm ambivalent. You could give me that future value, which is more, and either one is fine with me. That's in essence what IRR is. So like, let's take that $100,000 example, right? Let's say that your $100,000 investment, and you have, and let's just say the discount rate or your return on investment is 10%. That's like me saying, listen, Pablo, I'll give you $100,000 today, or I'll give you $110,000 a year from now. Which one are you taking?
$100,000 today.
I mean, they're equal. The net present value of both of them is the same.
Okay.
It's equal to, when we say equal to 0, that means it's equal to that amount, right? Like, because if you know that you can earn a 10% return on your money, right? You've already taken all the risks into account and all this other stuff.
Yeah.
You're saying, listen, I can earn 10. Well, then I should make the same. I am okay either taking $100,000 today or $110,000 in a year from now. It's the same.
Okay.
IRR allows you to do that because it helps calculate what is that discount rate, or what is that, another way of saying return on investment.